Hello and welcome to the inaugural podcast from the Mechanomics channel. My name is Martin McCann. I'm your host. I'm also the CEO and founder of TradeLedger. And on this channel, we will be speaking about macroeconomic topics that impact business performance. That's a topic which is of interest to me and to the people we'll be having conversations in this channel with. I'm delighted to have two longtime friends and colleagues with me this morning to have a conversation around the topics and the implications of that. I'd like to introduce, first of all, Alan Beattie. Alan has extensive international career in banking, over 30 years across most continents. After leaving banking, Alan has predominantly based himself in Australia and parts of Asia, including Hong Kong. He's been working in executive and advisory roles in various sectors of the financial markets, ranging from venture capital to fintech, and has even been involved in advising and helping to successfully deliver stock market listings. I also have with me today Alex Twig. Alex is also based in Sydney, and he is a 35-year banker and self-confessed tech geek, which is why we've had some very interesting conversations in pubs around the world over the years. He's been part of building 6 banks, including several SME banks over his career, starting most recently in Australia with Alex Bank and is co-founder of GeoBank, Trust Bank in Singapore by Standard Chartered, and UBank, which is part of NAB, and initially Egg in the UK a couple of decades back. Welcome both.
Thank you very much.
Great to have you both along for this conversation and this inaugural podcast. I'm delighted to say that I've managed to convince both of you to be part of the journey of my company, TradeLedger, building software to help banks to solve the problem that we're talking about today. TradeLedger provides software to banks that helps to digitize, automate, and embed the process of credit for businesses into various different channels and helps them to modernize and align with the needs of the modern AI-driven, increasingly embedded digital business world. I wrote this article a couple of weeks ago, which sort of examined the academic publications on bank lending changes, specifically the changes to business lending in bank balance sheets. And it was really interesting from a couple of topics. In researching the article, the thing that struck me is there's virtually no industry reports on this topic as to how bank balance sheets have shifted over time and what are the long-term implications of that. I found that very curious. The only relevant research I could find was from academia, and it tends to be high-quality research. So I sort of dug into that a little bit more. And most of the focus was overwhelmingly on exploring the link between inequality and increasingly large proportional shift of bank lending. And that shift is moving away from investment in businesses for working capital and growth and into mortgages. In the last 2 decades, there's been a material shift in the constitution of bank lending to the point where mortgages take up a much more significant proportion of the balance sheet than they ever did. And I mean, you look at it over the history of banks, this is the first time we've seen this situation. And, I'm curious as to why this is. That's why I wrote the article in the first place. As long-term bankers from different perspectives, I thought I'd open by asking you, why is this? Over to you first, Alex.
Oh, look, thanks, Martin. I think there's a key underlying theme, which is an unintended consequence of regulation. So for the last 20, 25 years, all the global regulators have moved to improve the strength of the banking system through a series of Basel regulations that have come through. And that's basically trying to create a framework to underwrite risk and how you allocate capital to risk on the balance sheet. What you found through that process is that all banks at the end of the day are driven, their commercial operations, and they're driven by a return on equity number. And that's how they're measured, and that's where their success comes from. And because there is a significant differential in the way that business lending and retail mortgage lending is valued on that risk curve, mortgage lending has been able to generate sustainably higher ROEs at a much lower risk point. So naturally, because that's what banks do, banks are big capital allocation engines. They have migrated to moving their capital to where that they can get the best returns. And they have to maintain a portfolio impact effect in the balance sheet, but that has had a significant movement in the way that capital has been allocated to those balance sheets globally. It's not a geographic specific issue, it's a global issue, and one that has fueled a housing boom across the last 20 odd years. And because of the pure mathematical turnover rate and churn rate of those mortgages as opposed to commercial lending, you've seen those average balances go up, you've seen the tenure go on, you've seen the risk weightings come down, and consequently you end up with the shift that we've seen.
Thank you for that explanation, Alex. That's really helpful in understanding what's going on. Alan, I wanted to you. What do you have to add to that sort of perspective?
Absolutely. I agree with Alex that capital is, and the returns on capital and the equity measures are the ways that banks are measured, not only by regulators, but by shareholders as well. So that has certainly had an impact. Bankers around the world do look at risk-adjusted returns in the same way that you allocate expenses where you get the greatest return on an investment. Bankers will look at the opportunity to get the greatest returns on the capital that they deploy into their lending products. There's also an interesting element to this because it's somewhat a self-fulfilling prophecy, because more lending that goes into mortgages therefore means that more people are able to, quite rightly, hopefully own their own home. Now, with rising prices of properties, because of the access to funding to purchase those properties, and of course, it's not just the access, but the loan to value, you can get up to 90% of the value of your property as a loan. That increases the underlying value of the asset against which you're lending as a banker. So if the value of the asset is going up over a period of years, bankers and risk officers and regulators will be more comfortable to see that the monies are going to what is at the end of the day a pretty secure means of putting assets onto a bank balance sheet.
Thank you for that, Alan. So what that leads me to question, as you're both describing what's going on, is, I guess, the longer term perspective on the role of banks and bank balance sheets in the economy, policy around why banks lend, how they lend, and what are the rules around what they lend and why. And I think, as a layman, I'm not a banker, I come from a tech background. The bit I struggle with understanding is, how does that perspective on a bank being a business fundamentally trying to increase and maximize shareholder returns, paraphrasing what you've both said, while reducing risks and being responsible stewards of the capital that they're responsible for, how does that interact with the role of the bank in the wider sort of macroeconomic dynamic globally over time, from the perspective of businesses generate economic growth? So how does that fit with policy is the question which is coming to my mind as you're talking. Is there policies that sort of give you a higher level set of directions as to what the balance sheet is to be used for? So, for example, we see a lot recently on the climate change, green investment, banks being a force for good. Is there some kind of direction or policy in place, or should we be talking about a policy which proportions or protects the amount of funding which banks have available for businesses for working capital and growth purposes? So essentially what I'm asking is, why are banks' balance sheets allowed to be apportioned this way? Why is that? And is it healthy? And is there a policy dimension to this conversation?
Well, so let me. There has to be. It's not just policy. It's many things, which I'm sure we'll come on to in a second. But I just wanted to mention that this, in terms of the apportionment of capital or assets on a balance sheet, is not going away, because there is forward-looking research out there that's saying that whilst bank balance sheets and lending has grown at something like 6.75% over the last 7 or 8 years, which is 2 to 3 times global GDP, depending on how you measure certain countries' GDP and whether you believe China's growing at 5-6%. So there is money being put out the door, and it's being put out the door at a greater rate than the GDP growth. That's a good thing. Now, actually, the amount of that, the proportion of that is going into mortgages is actually going to continue to increase, because their CAGR over the next 5-7 years is above 10%, whereas overall growth is supposed to be about 7%. So it's a challenge that's not going to go away. So how can we address these? How can we make the lending to businesses, and particularly smaller businesses, more attractive? And it's something that you and we have been looking at doing at Trade Ledger. It's about appropriate lending, sensible lending to the right customer at the right price and the right product, particularly for SMEs, is driven by the quality of the data that a banker or a bank has. Of course, it's not just banks, but we are talking about banks. There are alternative lenders that they have to hand to enable them to make those fast and correct decisions as to how to lend. Because as we were talking about capital allocation for lending, every time a loan is not repaid, you get bad debts. That goes into the measurement as to the safety of that type of lending. And therefore, over time, regulators and shareholders will call for greater capital to be allocated to that lending type. So it's about making sure that the complexity of lending to smaller businesses, particularly, but not just smaller businesses, enables the appropriate decisions to be made so that that lending book is safe.
So it sounds to me like you're saying there's a systemic problem that we need to consider in policy setting for banks, because fundamentally business lending is more risky than mortgage lending, and left to its own devices, banks will always favor increasing shareholder return with reducing risk, which leads them to mortgages.
Yeah, there's two really good examples for me for how to think about this, which is, generally speaking, regulatory task is primary regulatory task is safety of the banking system. Right. The first example of how you can change that is what the Australian government did around the Royal Bank of Australia and the targets for inflation.
Yeah.
Right. So under the previous model, there was only effectively a desire to keep the inflation figure at a particular level. That's now been changed for a social perspective around it now has to be balanced with unemployment, right? And that has, you've seen that shift in the way that the RBA now thinks about interest rate setting, and you've seen the way that when the notes come out, how that's changed their thinking. The other great example was through COVID. So the government stepped in, most governments stepped in. I can speak specifically about the Australian government, but the Australian government stepped in and issued billions of dollars to the banks on the promise that they would continue to lend to businesses through the COVID crisis at exceptionally low interest rates. Some could say that the banks sort of profiteered a little bit out of that, but it meant that the capital didn't seize up like it could have done, and it could have done really badly coming out of that COVID crisis. Now that is now unwound as we've gone through the last 3 or 4 years, but it's a great example of how political policy, if shaped correctly to get societal outcomes, can actually affect regulatory policy. We don't, at the moment, as far as I'm aware, anywhere in the world, have a regulatory policy framework for banks that has the same sort of social impact, and in our particular case, commercial lending focused regime.
So that's really interesting. So I think we've hit on something which needs to be discussed, I think, in broader circles than this conversation, around the impact of sort of government policy, central banks, and coordination of central bank policies across countries to try and solve this problem, which is fascinating and logical, but incredibly difficult. If we move a little bit more specifically, and I'll start with you, Alex, and I'll come back to you, Alan. The data consistently shows that, with the exception of large corporations, businesses across various sectors and regions face a shortage of bank credit. How do we fix that? Because the impacts are quite devastating for social objectives. I mean, businesses drive economic growth, they create employment, they create social mobility. They're how we apportion most of the resources in the world. So if most small and medium-sized businesses can't get working capital and growth credit from banks, which is one of their core objectives, we have a problem. How do we fix that?
It definitely needs to be fixed. What happens currently is they go outside the banking system for that credit. Let's call them micro to make it easy. Let's call them micro businesses, but basically they are considered to be individuals with a business number, right? And that's the way most banks treat them. Now, we have got to be a little bit careful in the stats, because in some cases those micro businesses will have their own homes and they borrow money against their own homes, which is effectively a retail mortgage, and that's how they pump equity into, or liquidity into, their businesses. In the sort of next tier up, let's call them the mid-size engineering firms type place, that's where you start to hit an issue, because they have to go to non-bank lenders for their, let's call it the last 20 or 30% of their credit needs. They'll probably have lines and facilities with the banks, and those will be based around the bank can see as their solid risk profile. But because we know the fluctuation nature of the way that businesses run, for that last 20 or 30% of credit that they need, they're going to non-bank lenders, and they're getting charged large rates of interest to compensate for the risk associated with those loans. What we've got to do is try and enable the policy framework to be able to bring down the risk rating of those new loans, to make sure that they could fit within the bank governance framework.
That's really interesting. And again, I think we're starting to dabble in topics that need to be discussed significantly outside of this conversation, but it feels like we're onto something with this discussion. Alan, I want to ask you a slightly different area of the specificity of business lending. So we just touched on what's going on with sort of particularly SME business lending, and we described what is essentially a really systemic problem with banking and the flow of credit into businesses, which needs a national or international sort of policy coordination and intervention strategy to fix is kind of what I'm hearing from the conversation. And I think where we're going now in terms of businesses going outside the bank system to get credit is an observation that I've seen as well while I've been running Trade Ledger, trying to help banks to lend more to businesses. I do wonder if I should have just ignored banks and started 8 years ago with other non-bank sources of capital being deployed to corporates, and whether we would have been more successful in this period of time, because it's incredibly hard to get banks to address this topic, which is what we've been trying to do at Trade Ledger. So Alan, coming back to you, we know there's a problem. Can you talk a little bit more about where businesses are getting capital from for working capital and growth purposes? Comment a little bit on, is this a significant shift in the role of banks in society? And specifically, one of the things I've seen is the rise of private equity funds and ownership of business assets. So both deployment of private funds through private equity into business lending and purchasing businesses outright and funding them with credit, which seems to be a specific and potentially very dangerous trend going on sort of macroeconomically. Can you comment a little bit about that, and what you think the impact of this shift away from banks lending to SMEs and it being plugged by non-bank lending is having?
So it's quite a lot to unpack there. So Alex, feel free to jump in, but let's try and slice this down into its discrete parts. It is fair to say that if you're going to put $1 billion out the door as a bank, right, underwrite $1 billion onto a balance sheet, you could go to a Fortune 500 company and you could argue that lazy banking is cutting a check for a Fortune 500 company for $1 billion. Now you have to go through due process to obviously get that underwritten. To do that for SMEs, and let's take, I don't know, $100,000, that's 10,000 loans that would have to be put out the door to equate to $1 billion on the balance sheet, if my maths is correct. Now, that requires a significant amount of work to get 10,000 customers to borrow $100,000 and get that money out of the door. So one of the problems is just the sheer volume of supporting SME business. Banks are hungry for technology. They do want to try and address the sort of legacy challenges they have with their technology, one, and two, to be able to address the challenge and meet the opportunity, or realize the opportunity of underwriting 10,000 loans in our example. There has also been an acute situation which is largely being resolved by the financial institutions of late, wherein to support 10,000 customers and putting money out the door for 10,000 customers, there was a lot of regulation and a lot of societal demand, quite rightly, for controls around money laundering and many other compliance factors. Do you know who you're lending to? Now, lending to one Fortune 500 name is a lot easier than, again, lending to 10,000 SMEs. So that's been a second challenge. So smaller businesses have started to look elsewhere, and we've seen that at Trade Ledger, and it's been a growing trend. Banks realize that there are competitive pressures from just not just the high street banks that they have seen historically. I mean, it's even all, it's coming from Goldman Sachs as well. I mean, Goldman Sachs 20 years ago didn't have a balance sheet to put money out the door. They now do. So it's not alternative lenders and sort of digital banks only. There are many people looking to support society in its business growth through working capital and other financial products. As regards where else are they going, they're all obviously going to alternative lenders. Private credit has been a hot topic for some years now. The extent to which it is lending into the micro and SME is probably questionable as to the extent to which that is really happening. Of course, one of the benefits of lending to 10,000 SMEs is you're diversifying your risk. And anybody running a balance sheet wants to diversify the risks. If you can get the money out the door efficiently, quickly, and in an appropriate way to the right customer, there is a benefit because it diversifies your balance sheet risk.
If I may, Alan, I think Alan's hit on a really, really good point here, which is for most banks, the cost of writing a commercial deal for $1 million is the same as writing one for $20 million, because the amount of effort and work that has to go in is the same. But the gross revenue that comes from the $1 million loan as opposed to the $20 million loan is a lot less. So, just a simple cost to income ratio is going to drive you mathematically to those larger loans. And this is the key element of where banks need to get better in their processes, is about being able to do that same job cheaper and faster. Faster's a second part of the equation. And I think faster plays into potentially the PE and the debt fund alternatives, because, for most businesses, if it takes you 3 weeks to get a yes, or worse, takes you 3 weeks to get a no, that's 2.5 weeks too long.
Yeah.
Right? Because deals go in that time. And that's what we've seen as a real issue for a lot of businesses. And banks, because generally speaking, most banks aren't quick, and it's only really the larger organizations that can wait around for that time. Private equity, as it does, debt funds, as they do, have seen that opportunity in the market, can be more nimble and can make those loans.
And that's where technology really has an opportunity to play a game-changing role. Because if you're able to ingest multiple data sources, and all three of us know that this is now technically possible, it's the application of that technology that still remains a bit of a challenge. But if you're able to ingest that data and interpret it and serve it up and sort of make informed decisions as to who to lend to in a timely manner, that serves everybody. And the quality and the veracity of the data will satisfy regulators if it's appropriately analyzed and stored. The money gets, as to Alex's point, it's not 3 weeks, it's 3 hours, where a decision comes back to an SME for their working capital needs, or indeed to anybody for working capital needs.
So I want to jump in there. We're kind of into the bonus question, Ron. We're getting to the end of the conversation. But Alan, you've really hit on a trigger for me in what you said earlier about banks are hungry for technology. I would argue they're not actually hungry for technology. or at least they're not hungry for technology-driven innovation. Let me explain what I mean by that. I think we're all in agreement, and I think everybody listening to this conversation will be in agreement that banks need to be able to lend to businesses faster and at lower cost, right? And arguably say as well at reduced risk to make this an attractive sort of scalable component of their balance sheet deployments going forward. Now, we collectively have been trying to provide what I would call generational shift technology to do that to banks, particularly business and commercial banks. As I've said in the article, we have not even made a dent. We've got a unique technology asset, arguably like next generation, which helps them to drive what I describe as hyper automation to reduce costs and time to make a decision. And it's hard going to convince banks to have that conversation. And we've got some observations and data points around why this is. I think one of them is to do with organizational design and policy. So most of the banks and bankers that I speak to on a regular basis, they're not tasked with solving these problems. They are tasked with growing the funds out the door by 3 to 5% a year potentially, but focused on not losing money and not getting fined by the regulator. Right. So within that context, they don't really have an interest in talking about tectonic shifts in sort of how you can hyper automate, reduce costs, reduce risks, and increase speed through sort of new business models, which is ultimately, as a tech innovator and disruptor, what I'm trying to do with TradeLedger. So when you say that banks are hungry for technology, I would argue that's a partially correct statement. Banks are hungry for technology which slightly improves their situation. Banks are almost allergic to technology which disrupts their own business models or has that sort of generational impact to solve a problem like this. And my view is something else needs to be applied to this equation in order for us to see the floodgates open and to see the level of technology adoption which changes business models and ultimately results in a significant increase in the flow of capital safely and profitably to smaller and mid-size. So I guess the open question to finish up this conversation, because it is a trigger for me and it is something I'm obviously very passionate about, as both a technologist and the founder of a company that provides technology to do this, is why is it so hard to get banks to adopt this type of technology? And what is the role of technology in solving the problem with deployment of higher levels of funding to SMEs, faster, lower cost, and at reasonable profitability and return?
Can I pick that one up first? As we said at the beginning, banks are risk-adverse organizations. At the top of organizations, at the very top of organizations, they know they need to change. In the middle of organizations, where careers are made and lost, they have people probably stay in a role for a couple of years maximum before they move on to the next one in these large places. Change is high risk. And even though there is, in Alan's words, a hungry desire for technology change from the very top of organizations, because that's where the difference is seen and that's where the strategic advantage can be seen, the strategic benefits aren't seen in the middles of organizations where these changes need to take effect. This, for me, is one of the biggest cultural issues inside our banking organizations around the world. It's why you've seen so many new entrant banks come to the market which are able to take and pick away at the niche parts and the profitable parts of the banking chain without much defense or even attack from the larger organizations. And that's the thing that's got to change. And what you eventually end up seeing is when enough of value has been eroded, then somebody has to take a last minute stand and they adopt it quickly. That's not saying they shouldn't adopt it, because they really should. It's how we overcome this cultural risk adverseness in the middle of large scale banks to make that change.
Yeah. I mean, just to nuance what you both said, and I agree with what you're saying. If you were to go to a head of commercial business bank in an organization, and you were to say to him or to her, look, I can do, on a separate balance sheet, I can run a completely new business on a separate balance sheet. You can do your business as usual, run your legacy book, but we're going to give you a new toy to underwrite new business, and you're going to get money out the door more safely, more quickly. They would bite your hand off. Now, we all know that because of conflicting priorities, because of budgetary constraints, because of time, the ability to focus on things such as that, and it's very difficult to run two balance sheets sometimes. That doesn't happen. So I think you, Martin, you and I particularly have been trolling the corridors of many organizations in many cities around the world, and we can see that there's an understanding of what it is that Trade Ledger is doing, but they just don't seem to be able to get their arms around it and move it forward as quickly as I think society requires of them.
I completely agree. The Trade Ledger and products like Trade Ledger, if there is such a thing, they can transform the way that banks lend and do credit. The change needs to be driven from the top of organizations and needs to be driven hard into those organizations. It needs to become a real key priority, given as much weight as growing the balance sheet by 3% per annum as we currently do today.
So thank you both. We're out of time. We're just getting to really interesting conversation topics. So maybe we need to reconvene about those in the future. In terms of this conversation related to what I term the silent crisis, how the change in bank lending to businesses is becoming a bit of a crisis. That's been a really interesting chat. I want to thank you both for contributing to the conversation. I want to sort of close up there. We will have the opportunity to have further conversations on the related topics that we brought up in the future, I hope. If you're tuned in listening to this conversation, I want to thank you for your attention and ask you for your feedback. This is the first in a series of conversations we want to have on important topics around how we figure out getting more capital deployed to businesses to drive economic growth, social mobility, reduce inequality, etc. So we hope you enjoyed this conversation. We look forward to seeing you tune in to future conversations on related topics. Thank you.